Welcome to Fidelity Soundbites, a monthly podcast where investors can tap into Fidelity's more than 400 investment experts who are on the ground around the world so that you have the inside edge when it comes to making more informed investment decisions. From equities to fixed income to private assets, let us help you build a better financial future.
Hello and welcome to Soundbites, Fidelity's podcast where we talk about all things investments. My name is Lukasz Pourbaix and I'm pleased to be joined today by Gary Monaghan, our investment director for Asian equities. Welcome, Gary.
Hey, Lukasz. Thanks for having me.
Now, Asia is obviously a fascinating part of the world from an investment perspective and certainly a focus for a lot of Australian investors. Now, we've been running our Asia strategy for over 20 years, which is a long time. And over that time, the market no doubt has evolved and changed. If you were sort of to take us through, what are some of the key shifts and observations over those 20 years that you've observed, and how has that market evolved in that time?
It's chalk and cheese. If you're putting them side by side, I mean, they're very, very different. That being said, there are still a few companies from 20 years ago that still exist today.
Yeah.
And
yeah.
You know, the big Chinese banks, for example, were quite dominant 20 or so years ago. You know, there's still sort of big players in the index overall.
Yeah.
But if you take a step back, just think of China, where it was, you know, the manufacturer of the world. Yeah. Yes, it still is, but it's less of a copy and paste merchant, and actually it leads in a number of, you know, sort of leading edge manufacturing processes, and you know, cars, for example, in electric vehicles. You know, who would have thought you may be considering buying a Chinese car 20 years ago? Absolutely. But also thinking about the China index and the China makeup and the market. Got stocks like Alibaba, Tencent, social media platforms, e-commerce. That shift and rise of the middle class has come hand in hand with technological sort of evolution and the way people purchase and the way people have relationships with companies. It's very much different. And you see this a lot in Asia as well, actually, is that if you take the traditional Western consumer mentality, the way things had evolved is you went to the high street, you went to the shops, you know, you bought your products. In Asia, and particularly China is a great example here, but other markets around the region as well, the infrastructure wasn't really there. You didn't have so much the high street. And so people just almost bypassed that and went straight to e-commerce. And so the relationship between the companies that are selling stuff, whatever it may well be, and the consumer has evolved almost very differently to the Western sort of markets, which are now actually doing that themselves. And so you've just seen very significant change driven by technology and the things that go around that as well. Yeah,
absolutely. And so it's an interesting point because it certainly has shifted. And again, if we think about China as that sort of manufacturing hub, and the sort of shift towards technology has been quite astounding. And obviously we've seen, you know, developments in some of the AI technology and so forth, and EVs, as you mentioned. So very much a shift from, you know, just a factory to, in some ways, a leader in some technology, particularly in EVs. So, I mean, that's been a dramatic shift. And if you think about some of the other regions and other countries and observations, so India's an interesting one, obviously, because it forms a large part of the market as well. Very different from China in terms of some of the structural drivers. But how have you sort of observed India over that sort of 20-year period?
Yeah, well, I would actually take the viewpoint of the way our clients are thinking about India. If you were talking about India 10 years ago, it was, you know, not even in the top 10 markets of what people were thinking about. It was really a frontier market in the way people were thinking about India as well. But today it's something that people want to consider. They know about the population size, the potential growth there. I mean, look, today India's GDP per capita is roughly where China was 15 years ago. So, and so it could be a real sort of opportunity for a growth market. That mentality shift from clients is significant, but also alongside that as well is that you're seeing a rise and emergence of a whole bunch of companies again that you maybe never heard of. I mean, just if you're going to take a 20-year sort of history, who would have thought 20 years ago that an Indian company, Tata Motor, would own Jaguar and Land Rover?
And, absolutely.
And so it just gives you a sense that some of these markets, which were 20 years ago considered not even considered, I should say, from an investor's perspective generally, now are in the conversation at least. And a lot of that is down to the, obviously the ongoing development, the growth of the market there, but also the companies that are going hand in hand with it as well. But I will say there are still across the whole region, there are still a few things that stay the same.
Yeah.
Obviously, you've got to think about state ownership.
Yeah.
The fact that the markets are still not, fully developed, fully mature. So you've got a significant retail base that can whipsaw the markets around quite significantly. And of course, a lot of these companies, not all, but there's still a lot of family ownership as well across the region, which, again, if you're taking more developed markets, families have generally long gone. Yeah. And it's more of a you could almost argue, a faceless sort of management team.
Yes.
But there are some things that have stayed the same regardless of how the markets have developed.
Yeah, absolutely. So, I guess that sort of just, the whole aspect and the focus on governance is still very much relevant when looking at some of these regions. The interesting one, just to round things off in terms of some of the observations, and it's sort of, you alluded to a little bit in terms of your comments on China, but if you think about Taiwan and Korea, and again, if you sort of relate that to the whole sort of tech theme and AI, and obviously they're leaders in semiconductors, that's been an incredible journey for those countries in terms of their position in these market-leading technology, and how's any insights there in terms of the evolution of that and how that's sort of panned out?
Yeah, well, they've evolved in terms of the technology is just again, it's just evolved so significantly that it's not recognizable. But just going back to my point earlier around what has been the same, Korea and Taiwan have largely for the last 20 years been the broad sort of manufacturer of technology products. So that in itself hasn't changed. It's just the technology itself is a thing that's evolved, and they've become much more sort of leading edge in the way that they do things. But Honhai, as an example, is a stock that was still a significant part of the benchmark 20 years ago, and it's still a stock that people will know. Obviously, they make everything through a Foxconn, make everything for Apple. So there are companies, TSMC was one of the, if not the biggest stock in the index 20 years ago. Yeah. It was about, I was looking at the data earlier, it's about 3.5-4% of the index 20 years ago.
Yeah, wow.
It's bigger now.
Yeah.
But it was still here.
Yes.
And it was still there, I should say, and it's still here today.
Yeah. And if you think about the market more broadly, outside of those sort of some of those big markets, there's other markets that over time people have been very interested in, whether it's Thailand, whether it's Vietnam, and so forth. But over, historically, some of the challenges have been the depth of the market, like in terms of particularly, if you're allocating to those markets, how deep are those markets and so forth. Has that evolved? Has that changed in any way? Are you seeing more depth, more liquidity in those markets, or it's still problematic?
It's still on the problematic side. Yes, they're bigger, but the other markets have got bigger as well around them. And it's still a lack of depth, as you say, and liquidity there as well. That creates a bit of a challenge. And so, from our perspective, the ASEAN markets, they've got some opportunities there. It's always interesting, can be quite volatile, which can create opportunities as well. But that depth and that liquidity you're alluding to just probably still eludes eludes the market overall. Yeah.
So if we sort of fast forward to the current period, and obviously, there's a lot happening. We got tariffs, we got geopolitical. There's a whole bunch of things happening, and certainly Asia's at the forefront of some of those things. And if you think about, what are some of the key challenges and opportunities today in that market? If you think about some of the notable things, you've had onshoring in terms of some of the manufacturing, the whole concept of sort of friendshoring, all of these sort of, movements in sort of, I guess, trade routes and so forth. How is that impacting the Asian region more broadly? And many commentators sort of put it as a I guess a negative, but are there opportunities as well with some of these sort of structural shifts?
So the shift, if you like, away from China, as we were talking about earlier, 20 years ago, it was the manufacturer of just pretty much everything. Now it's moving manufacturing to more leading edge, high tech sort of components and so on. But what's been happening, particularly in the last, let's call it 5 years or so, and sped up by tariffs, the first round of tariffs in 2018 from the US actually, is that Chinese companies and also international companies that manufacture in China have been looking for sort of other avenues and other places to manufacture. Okay, that sort of maybe pulls out some of the factories and some of the the jobs from China. From an Asia perspective, it's broadly okay because those companies are actually relocating to Vietnam or Indonesia or somewhere else in the region. They're not going completely away from the area. So that in itself is, from a broad Asia perspective, it just sort of shifts the chess pieces around the board a bit, but it doesn't impact sort of too structurally. And it's because people are following where the wages are lower, if there's maybe resources, et cetera, et cetera. So it's had an impact, it does, but it also, it doesn't impact the broader region. Also, if you go down to the sort of nuts and bolts from a corporate perspective, actually some of that moving around of manufacturing base is actually better because it's lower cost. It helps the margins. If you were to keep your factory in China, there's a good chance that as the wages are going up, the cost of producing is going up, it's going to crimp your margins. So you have to look for other avenues. And so it's just a natural evolution, I would argue, as well, partly. And some of it been sped up by tariffs and geopolitics, but it's an evolution of the way the world evolves. Basically.
I mean, I guess we've seen it multiple times in developed regions over the years. So it does sound like it's a natural sort of evolution. I think if we then talk about maybe some of the opportunities we're seeing on the ground. I mean, obviously we've got a large pool of analysts across the region on the ground looking at companies. What are some of the themes, some of the observations they're seeing on the ground? On a company level? I mean, obviously it's very much case by case, company by company, but are there any sort of themes that are emerging in recent times that are worth noting?
Yeah, I think if you're looking again, without getting into company by company, if you try and distill it down, there is opportunities linked just broadly to the rising consumer and the changing sort of trends and tastes of that consumer. But it does differ. So if I'm looking at, for example, in China, the rising middle class, that big burst of rising middle class is arguably a story from a decade ago. And now as that consumer is maturing, they're making more, if you want to call them sort of rational choices around where's the value, in the product that I want to purchase, rather than maybe I want to buy the most expensive thing because I've never owned it before. So you're starting to see trends of, if we want to call it maybe trading down or thinking more about experiences and services over just getting the next handbag. Still that exists, but it's maybe not as prevalent as it was. But then you go to a market like India, which, as I was saying earlier, the GDP per capita is where China was 15 years ago. That is a new middle class. And people are now wanting to buy things, whether it's a car or other smartphones, etc., because they've never really had that before. So it's just different stages of the consumer cycle. But importantly, the consumer and the rising middle class, which we've been seeing, and the ongoing development means that the consumer is a really, really important sort of driver and factor across the region. I would add another one, of course, global theme, but tech. And it manifests itself in different ways. But if you think in the US, obviously to think about AI and it's the servers and AWS for Amazon, etc. In Asia, you could argue that one of the bigger themes is that Asia is the enabler of AI. It makes the components. If TSMC, through its foundries, couldn't make the chips, AI unlikely would be where it is today. SK Hynix and Samsung Electronics, both in Korea, are the absolute global leaders in DRAM memory, which is absolutely essential for a lot of this, these products to be working. So the sort of AI theme, as we think about it, Asia is very much the enabler. It's the tech component part of that theme overall.
Yeah. So, I mean, if you're of the view that AI is going to sort of continue to evolve, I mean, Asia's front and center of that thematic.
It is, yeah. You could almost put Asia as they provide the picks and shovels, for the end product, basically. And so that to us is quite an attractive place to be.
Yeah.
Because you're not trying to pick the end company that might be, the winner. Yeah. You're providing the picks and shovels essentially, or the virtual, the technology equivalent of picks and shovels.
Yeah, absolutely. I mean, I guess one of the interesting ones, and we were talking a little bit about, stock specific examples and, your comments around the consumer. And one of the companies that you mentioned that you recently have looked at is China Resources Beer, which is an interesting name, China Resources Beer. I didn't know beer was a resource, but take us through the investment thesis there, because I do recall many years ago, brewers more generally, that was a big theme globally in terms of investment opportunities. I haven't heard of this company actually, so take us through that thesis and some of the key takeouts on that company.
Yeah, I think just from the big sort of broad sense, there's pretty much a growing amount of volume of beer demand in China. Tastes are changing. So as I was saying, as people have sort of moved along and evolved, tastes and trends, etc., change. And so in China, there's a lot of people who just want to have a beer, right? and don't get me wrong, people still want to have a baijiu and what have you, but you're certainly seeing people want to sit down with a few cans, basically, and you do see that. So there's a sort of a trend there with some volume growth, which is interesting. Then you take someone like China Resources Beer, as you just alluded to. Over time, they've increasingly been adding a bunch of well-known brands under their umbrella. Right. So if it's licensing or brewing and distributing within China, so the likes of Heineken, for example, is within China is under the China Resources umbrella. Yeah. But they also have their own brand called Snow, which, it's not to everyone's taste, maybe, but it's very, very popular, and it's at a price point that makes it popular as well. Yeah. So they've got a company like China Resources Beer. They've got a whole suite of products or brands across the shelves. Yeah. So you could go into a supermarket, and you might think, okay, there's 6 or 7 choices, without knowing that actually you're putting one company owns them. Yeah. So for us, something like that is really interesting. And of course, they're going through, they're big, it helps them with cost control. So you've got volume, cost control. It's quite for us, it's not going to be the type of stock that's 10% of your fund. It's going to be at the low end. It's a good opportunity. It might not be a 20-year opportunity, but for us right now, something like that is it's worth a go for a small position in the portfolio.
Yeah. And I guess more broadly on the Asian market, I mean, if you sort of think about a narrative in developed markets over recent times, a lot of focus has been on the Mag 7 and the dominance of some of those tech companies in that benchmark. But probably one thing that hasn't been as prominent in the news is, the Asian market as well has had its own sort of version, I guess, of maybe not the Mag 7, but, Mag 1 or 2. And as an investor, how do you sort of manage that concentration in terms of when you do have a couple of companies that are really driving a lot of the benchmark returns? Being an active manager, it's a hard one because, some of these stocks may be expensive, but if you don't own them, it can be challenging, right? So how do you navigate that environment?
It's a challenge because, as you say, if you don't own them, and we've gone through periods where we don't own a number of these, and it can go against you and it can be a bit painful. Yeah. That being said, you go stock by stock. So for us, stock by stock, is it worth a while a position or not? And sometimes, as you said, maybe the value is just, it's too expensive, or maybe you see the fundamentals for the coming year, 2 years, maybe deteriorating from where they're at. And in which case you stick by the process and you move on, which can be hard to do. Yeah. But then you therefore have to find ideas that you think can outpace. And you can do that for sure. I mean, look, for a number of years, we didn't own Alibaba and Tencent, big stock heavyweights in the index, but you could still outperform because you could own something like actually going back to the alcohol one, Kweichow Multi, which do Baijiu.
So it's a bit theme here.
I know, yeah. But Kweichow Multi, the Baijiu company, which outpaced them. And so you have a bigger position that outweighs those, and you can sort of offset. You do lose on one, but you can gain more on the other. One of the other challenges, though, that being said, from this sort of concentration point of view, is that when you get more and more ETF flows from passive, which Asia still doesn't have too much of at the moment, money will just automatically go into the big stocks, regardless of the valuation. So you do have to be aware of that. But again, try and find those stocks where you think can outpace over time. And that's where you can try and sort of mitigate some of those concentration issues that you're talking about.
And so if you final question from me is you look ahead for the next 12 months, and if you're the listeners out there might be thinking about, looking at Asia as a market to invest in, I mean, what would be your top 3 opportunities in terms of Asian markets more broadly? Could be, some companies that you're interested in, but, what are those top 3 things that you're really focusing on that you see the opportunities for the coming 12 months?
I think as you're looking, we can go into some stocks in a moment, but I think as we're looking at the sort of broader Asia market and the opportunity there, I think there's a few high-level tailwinds that could be quite positive more broadly, and just hopefully will bring in a bit of flow of money. One is that if we start to get dollar depreciation, maybe we get rate cuts, dollar depreciation, whether it's true or not, the mindset of investors is lowered. The depreciating dollar is good for Asian assets. And so you could see, as people are concerned about the US exceptionalism coming to an end, et cetera, that sort of thing, could depreciating dollar rate cuts be the catalyst for people to trim US and buy something else? So that could be a trend that's of interest. Linked to that actually as well is around flows, and particularly from domestic investors. We've been seeing this year markets like Korea, India, China as well in particular, a lot of domestic flow into the market, which particularly in China hasn't really been there for the last few years. So the boots on the ground, i.e. the people who are living it, are actually putting their hands in their pockets and buying their own markets for the first time. Korea is a great example as well, where I mean, different numbers, but there's estimates of like $100 billion was leaving Korea in 2023 and 2024 to buy the US. And with various changes around regulatory changes or pushes to get companies to pay out more dividends and so on, a lot of that money, or not all of it, but at least a big chunk of that money is repatriated back home. And so that's another trend I think could be quite interesting and something to observe. Stock-wise, the challenge, what I'll say here, is that it could change.
Of course.
As the facts change, the comments will change. Absolutely. But I think if we're looking at China, there's some interesting opportunities emerging in the, if you want to call it the internet space, the broad internet space. So Tencent is one. I mean, it's a big stock. Everyone knows it. It's one that we didn't own at the beginning of the year. Look, the gaming business that they've got is good. They've got the massive, huge social media platforms, WeChat, as the people in the West would call it. And that company, for us, it's good, but it didn't really have the next catalyst. DeepSeek came along. And suddenly it was like, oh, okay, Chinese companies can access sort of AI models, which was something that no one had really factored in. And then you start to do the work and think, right, who can actually adopt AI to improve monetization? It's not easy to do. So AI is good at improving your efficiency and maybe, creating a few reports quicker, etc. But it doesn't make you, very few people have found out how to use AI to really make you money in a big way. And Tencent was an interesting one because they've been working on and for us sort of demonstrating that they can use AI to better connect their users with advertisements. So they can better use your data basically with the help of AI to connect the user to the products that maybe you didn't know you wanted, or they can tailor the advert to your taste. So maybe they know the colors that you like and so on. So it's using that there, which for us was an interesting angle, which could really drive future revenue through, let's call it better advertising strategy and improve the click-through rates. And we found an opportunity to buy it because back in April, like we didn't own Tencent. It went up a lot. It went from about 380 to 550, with 0.8. But actually, as it was going up from there, you do the work on AI. You think it's interesting. You're waiting for an entry point. And then Trump came along with Liberation Day and tariffs. Tencent doesn't sell a bean to the US. But the stock price fell because it's Asia, it's China, people just sold. Stock tanked in the first week of April, and it was a buying opportunity. Suddenly it's right, okay, we can buy Tencent at only a 10% premium to what it was pre-DeepSeek and pre-AI. So you can buy into that, and now you ride the wave up. So for us, it could be interesting, and the expectations for the future sort of outlook for advertising and advertising revenues has improved a lot from the market perspective.
Yeah. Well, Gary, thank you very much for your time. And that was really, really insightful. I mean, I think no doubt the Asian market will continue to evolve in the coming years and continue to be a key focus for a lot of Australian investors. So thank you. And thank you to the listeners for taking the time to listen.
Thank you.
If you've enjoyed today's episode, make sure to subscribe to Soundbites on your favourite podcasting platform. Otherwise, if you'd like more information on Fidelity or Fidelity products, please head to our website at fidelity.com.au. Now for some important information. This podcast is issued by Phil Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation, or needs. You should consider the product disclosure statement and target market determinations for Fidelity Australia products at fidelity.com.au. Please click the link in the show's description to read the full disclaimer.